In this week's market update, interest rates are in focus after unexpectedly strong jobs data. The big June rally sees active managers struggle, and Wall Street's banking giants are divided on the outlook for markets. The Federal Reserve is the most powerful force in markets today as investors focus on the US central bank's interest rate policy. Expectations for lower rates have become the principal support for the stock market as the economic outlook deteriorates. Expectations of higher rates were the main driver of market weakness in the fourth quarter of 2018, and the Fed's change of direction in the first quarter of this year provided the underpinning for a V-shaped market rally. Since then, markets have gone sideways and been volatile as expectations have fluctuated on the direction and scale of interest rate moves during the rest of 2019 and into next year. The big event in the past few days was an unexpectedly strong non-farm payroll report last Friday, which reversed weakness in the jobs market in May and pointed to less need for monetary easing than the markets had begun to price in. That was enough to bring Wall Street back from its pre-Independence Day record high. Although shares are holding on close to their all-time high in the US, the improving economic situation has ironically depressed the investment mood music this week. The Fed will remain in focus as Chairman Jay Powell is grilled by Congress in his twice-yearly testimony to America's top politicians. Before that, he's due to speak at a conference given by the Boston Fed. Expectations last week were for a cut of up to 50 basis points at the next meeting on the last 2 days of July. Now, forecasts have been reined back to a quarter-point cut to between 2% and 2.25%. That's still significant in that it would represent the first change in direction for US interest rates since the current tightening cycle began in 2015. But the market reaction shows the scope for disappointment when a dovish policy path has already been priced in. The expectation of lower rates was the main driver of the best June for US stocks since 1955. The S&P 500 added 7% last month, boosting gains for the year to date to more than 17%, which was the strongest first half showing since 1997. While a strong market performance like that is great news for investors, it proved to be a mixed blessing for active fund managers who can often struggle to match the market gains in periods of rapid rises. Just 31% of active mutual fund managers were able to beat the Russell 1000 index in June, according to Bank of America. That brought the proportion who have beaten the market in the first half year down from 47% at the end of May to just 41% at the end of June. This is a problem for active managers because they're already fighting to counter an ongoing shift of money to lower-cost passive funds. Active funds tend to outperform falling markets because they're able to pick the most defensive stocks. Unfortunately, after a long bull market, many investors will have shifted into tracker funds just in time for them to start underperforming. As well as interest rate hopes, markets were boosted in June by an easing of trade tensions between the US and China. President Trump's meeting with President Xi of China at the G20 summit in Osaka a few weeks back raised hopes that a full-blown trade war can be averted. One of the reasons active managers do relatively badly during periods of rising markets is that the growth investment style, which favours shares enjoying positive momentum, tends to outperform the value style, which looks for shares which are deemed to be unfairly out of favour. Many active managers adopt this value approach. Investors have pulled nearly $100 billion out of actively managed funds investing in the US market this year. The last time there was a positive month of flows into these funds was in 2014. Looking ahead, the outlook for markets is uncertain. Even the big beasts of Wall Street are divided, with Morgan Stanley issuing a warning that markets could fall this year, while JP Morgan expects further gains of up to 15%. Morgan Stanley says that earnings estimates are too high in a weak economic environment and believes investors are too optimistic that central banks will ride to the rescue with much lower rates. JP Morgan, on the other hand, argues that earnings growth estimates are still trailing those at previous market peaks, and it thinks that the multiple of those earnings that investors are prepared to pay could go higher still. The end of the stock market cycle is often characterised by a strong upward momentum, as investors who've missed out on gains through the bull market attempt to join the party. This two-way pull provides the backdrop to my latest quarterly investment outlook, in which the only outright positive view in asset class terms is for cash, with a neutral stance on shares, bonds and commodities. Commercial property has a negative flag thanks to excessive valuations as investors chase yield in a low interest rate environment. When it comes to geographic regions in the equity market, the latest outlook remains positive on the UK, Europe and Japan, all on valuation grounds. Both the US and Asia Pacific are neutral, reflecting relatively high valuations in the US and worries about trade tensions in China. The UK in particular remains significantly out of favour for the very obvious reason that the ongoing Brexit impasse is hitting confidence among both companies and individual households. UK retail sales were the worst on record in June, according to the British Retail Consortium and KPMG. Although real inflation-adjusted wages are rising, that's failing to translate into higher spending as consumers put off non-essential purchases. With the leadership election in the Conservative Party drawing to a close, it now looks very likely that the next UK Prime Minister will be Boris Johnson, who's standing on a do-or-die Brexit ticket, promising that Britain will leave the EU at the end of October, come what may. That puts him on a collision path with many MPs, probably the majority, which will make it extremely difficult to push a hard Brexit through Parliament. That, in turn, sets up the possibility of an autumn election with an uncertain outcome. Although the Conservative Party is unpopular because of its handling of Brexit, so too is Labour for a variety of reasons. No one can call an election result at this stage with any degree of confidence at all. And uncertainty is likely to cast a cloud over financial markets here in the UK for the rest of the year. Meanwhile, in Europe, the transition from Mario Draghi's 8 years at the helm of the European Central Bank looks like being a case of more of the same. The nominee to be his replacement is IMF head Christine Lagarde, who's thought to share Mr Draghi's broadly dovish approach to monetary policy. That means lower for longer interest rates in Europe for the foreseeable future.